Most of us avoid talking about care home costs, but ignoring it can be a huge financial mistake. As we age, daily tasks can become difficult, and care homes provide essential support and safety. The reality? This care comes with a hefty price tag that can wipe out savings and assets. Many assume the state will cover everything, but that's rarely true. The system is complex, varies by location, and often expects you to pay first. Planning ahead is crucial to protect your assets and ensure you have choices. Your home, savings, and pension could all be at risk. Without knowledge, your assets can disappear quickly. This isn't about fear. It's about being prepared and knowing your rights. We'll break down costs, what happens to your assets, and how to protect your financial future. Facing care costs is the first step to taking control. Knowledge is power, and it could protect everything you've worked for. Let's get started. Care home costs vary dramatically by country. In the UK, expect £35,000, £50,000 per year, with higher costs in London and the South East. In the US, a private nursing home room averages over $100,000 annually. Assisted living is about $54,000. Medicaid only helps after you've spent nearly all your assets. In Canada, government subsidies help, but residents still pay $24,000, $42,000 a year, based on income. Australia subsidises care, but you'll pay a basic daily fee, a means-tested fee, and possibly a large accommodation deposit. Predicting exact costs is tough. Formal assessments are often needed. No matter where you live, the bills add up fast. Understanding your country's system is essential. Paying for care starts with a means test. Your assets and income are assessed. In the UK, if your assets exceed £23,250, you pay in full, and your home is usually included unless a spouse lives there. In the US, Medicaid requires you to spend down assets. Your home may be exempt if a spouse lives there, but estate recovery can claim it later. Canada focuses on income, not assets, so you may keep your home but lose most of your pension income to care costs. Australia assesses both income and assets. Your home is exempt if a spouse lives there, but otherwise it's counted up to a capped value. Many end up selling their home or using most of their income to pay for care. The rules are strict and vary by country. Planning ahead can help you avoid nasty surprises. How can you protect your assets? Start planning early. Trusts can shield assets, but if authorities think you're dodging care fees, they'll ignore the trust. Long-term care insurance is an option, but it's expensive and complex. In the UK, deferred payment agreements let you delay selling your home until after death. In the US, annuities and special insurance partnerships can help, but require expert advice. Gifting assets is risky. Timing and intent matter, and authorities can penalize you for deliberate deprivation. The best move? Get professional advice tailored to your situation. Asset protection is not a DIY project. The earlier you plan, the more options you'll have. Don't wait for a crisis. Act now. Will you have to sell your house? In the UK, US, and Australia, it's likely if no spouse or dependent lives there. In Canada, it's usually protected. What about your pension? Most of it will go toward care costs, with only a small personal allowance. Can you just give your house to your kids? Gifting assets can trigger penalties if done too close to needing care. There are look-back periods and strict rules. Is free care possible? Rarely. Only strict health-based criteria or total impoverishment qualify for full state coverage. The idea of the state paying everything is mostly a myth. Planning to pay something is realistic. The key: understand the rules, plan early, and seek expert advice. That's how you protect your future and your family.